tired of being broke, you need to flip or buy and hold. Clocking in and out, your 9 to 5 is getting old. JD Boom and AC Cash, they known to get the bag. You can make your own schedule, know you liking that. Time to take the next step, take your money, invest. Know you just got that check, go sign up with JTech. Yeah.
All right, Boom.
Yes, sir.
We covered all this other stuff. We gotta talk about some real estate.
It's other stuff. Come on, that's money makers.
Yeah,
man.
we talked about, some crypto. We talked a little bit about stocks. Yeah, and right now, let's cover this real estate. Let's talk about how to win in 2022 in real estate investment. Part 4. Hey, Pivot Point Investors. Let's get it. Hi, I'm AC Cash, and this is
JD.
We're here on behalf of Pivot Point Investors, where we help the average investor grow his nest egg.
Yes.
And today we're still talking this 2022 action.
Yeah.
We're talking about how to win.
That's right.
How to win with these stocks.
That's right.
This crypto.
Yeah.
And this real estate.
Yeah.
And man, it's part 4. Of this series. And today we're talking about real estate. We're talking about how to win in 2022 with real estate.
That's right.
A topic near and dear to my heart. It's very
like
important.
I knew it would be. What I tell y'all,
Yeah, it's
man.
important. People have to live somewhere, right?
Oh,
and they
man.
got to pay money for where they live.
That's true.
And either by rent or by mortgage, right?
That's right. That's
so
right.
somebody's got to talk about it.
Hey, but notice his energy level is just this much
Hey,
higher with
gotta
this
get a little
topic.
energy. That's all
With
right.
this topic,
I don't know if that's hate. I had to check and see if that's
Hey,
hate.
man,
Hey, and with the great things that are happening, it's always a good time to invest,
Oh, yeah.
and especially in real estate. But if we're going to invest in real estate today, we're going to be winners, we got to kind of do a flashback. If
Yeah.
we're going to flashback, we got to talk about times where things were a little rough, a little rockier, times that might make the average investor a little more apprehensive.
That's right.
Because we're talking about being bullish today about buying something.
Yeah.
Well, when is it time to be a bear? When is it time to hold your money?
Yeah.
So let's do a flashback, Mr. Boone. Can you
Yeah.
help me out?
Let's do it. Let's go back to what you would call, and you even said
That's
it,
right.
the great real estate market
Real estate
crash in
crash.
2008, right?
2008. Yes.
So during that time period, the bubble popped December 30th, 2028.
Yeah.
And that was due to increased foreclosures between 2006 2007.
Okay, and we said a bubble pop. That means we were rising high. Everybody was. Man,
it's
people
like
were flipping.
every month.
Oh yeah.
It's the month high. Yeah, give an
Man.
example of
Ooh,
that.
a crazy example.
Yeah, the Wild Wild West days.
Well, a lot of people, man, we're based in Atlanta. A lot of people are coming to, particularly Atlanta in this case, and they were coming from higher price markets. And they would say, oh man, stuff gonna go up 10% every few months. Man, I'm gonna buy something here. Stuff 100,000, 120,000. I'm buying everything.
Okay.
And I'm saying, yo, this is temporary. It doesn't do this all the time because all parties got to end sooner or later.
That's right.
And so here I was actually in the middle of it was a 24 unit apartment complex, 6 units of quadruplexes. So 4, 6 times, 24 units. And as I'm on with the mortgage broker, the guy's on the phone saying, oh, well, this mortgage company just closed today. They went out of business, but don't worry about that. We got this other one. And he's on the phone 10 minutes later, hey, this one closed today and they're not doing any more lending. And by the time he got to the third one, he was crying on the phone.
Oh, wow.
We're talking a 50-year-old grown man in the industry for years, crying. I still hear the man on the phone crying,
man,
saying, man, they're all closing, man. It's terrible, it's terrible. He was out of business on that day because if a mortgage broker can't lend money, he's out of business. He needs to change the game. And obviously, I couldn't buy the units. Everything went crazy. And that's my 2008 kind of moment of, it's hit the fan.
It's a real moment of clarity.
Oh,
real
for sure. A lot of money lost during that time. But now we look at now, and people with scars from that time would say, oh, stuff going up, should we invest? I remember 2008, and I'm scared.
Yeah.
But we have different conditions now.
Totally different.
And we're going to stay in this era of back then and see, should we be investing today?
Yeah.
Hey,
yeah, that's
what
true.
are we talking about?
That's true. So housing prices fell initially in 2008 nationwide about 16%.
16%.
Now that wasn't the total fall. That was just the initial 2008, and it kept falling every month as those foreclosures kept coming, one after the other, bigger each month.
Yeah.
And then each year, 07, and then in 08, the market kept dipping, or at least the prices. And then, 08, 09,
Right.
10, 11, it kept going.
It went for an extended period of time.
Yeah.
Doesn't mean people weren't making money. That's when the people were acquiring properties.
Yeah.
But they had to be ready for that.
Absolutely.
And so that you just have to keep yesterday in mind as we go forward.
That's right. That's right. So the foreclosure for 2008, it was over 3.1 million foreclosures. So that's
foreclosures.
a bunch of properties. They were up 81% in
From
foreclosures
the previous year, 07, you got a number, and now we're 81% greater in foreclosures.
That's
that
right.
meant it hit the fan for real.
Yeah. So, but the cool thing, let's talk recovery. That was the gloom and doom, but
That's when you get the happy music and stuff. Hey, we're coming back. We're shopping.
That's right. So that's 2013.
Yeah.
So we kind of getting jiggy with it again. 2013, nationwide median prices, for single family homes appreciated by 12.5%, from Q3 to Q2 2012. And so some cities even went up over 40% appreciation, during time periods in that year.
That's right. So a lot of things happened during that time. I had friends who disputed some of the foreclosures back then, and the banks were fraudulently just foreclosing on people, trying to mitigate their losses, but they were doing it incorrectly, where they ended up having to give them titles to the property free and clear because they incorrectly foreclosed.
That rubble stamp stuff.
Yeah, they would just stamp it. They late, we foreclosing, when that was illegal.
Yeah.
So many things were happening. But then there were other people, there were banks sitting there with that REO division, that real estate owned division, where they taken back a bunch of properties, and then they had to get them off their books. Because banks aren't in the real estate business, they're in the lending business. And so to get those assets off of their books, they were selling properties dirt cheap, just dirt cheap. And again, the people with money, the investors, the people who were just saying, I'm gonna make sure my money's right, they were ready to take advantage of those situations. And so anytime somebody's crying, somebody's smiling.
Yeah, I remember like yesterday, between 13 and 2016, investors purchasing homes $5,000-$10,000 in certain parts of Metro Atlanta. Now this wasn't wasn't the pristine parts. It wasn't Buckhead.
Hey, you get your money where you get your money.
Some of the houses were shotgun. They could have fallen down. But where can you get $5,000 of a property in a real legit property?
Yeah, Detroit.
Other than that.
Yeah. I'm sorry, Detroit.
Oh, that's hilarious.
They're doing things, but you got to be careful there too.
Yeah.
But so now we're looking at this market today. We're saying we've been through that, and again, if past is prologue, we need to learn from what happened wrong yesterday to see what we can do correctly today.
Yeah.
Now we aren't on the brink of 2008 repeat. We're not on the brink of that.
I don't think we'll ever go there again, because what were the conditions?
Now, did you say ever going to?
Well, I think it'd be very hard.
Let's say right now.
Yeah, right now I think it'd be very hard.
Boy,
and only because
I felt hives coming out of the man saying, but we never.
I say that only because it was a lot of things that were just crazy. No docs, no social, no.
So no doc loans, meaning, hey, walk in if you got a post, sign this, and yes, ma'am, I know you haven't really had a income for 10 years and everything's shady. How you get your money? But you can get that $600,000 house. Come on in. That's no doc loans.
No docs, no pay stubs, no bank statements.
We don't need all that.
No documentation about who you are. I'm even kind of shaky if they even looked at a driver's license.
Yeah, they had to check the driver's license.
I don't know, man. With some of these people,
It felt that way.
You know, so.
But we have to consider today, some of those products are creeping back into the market.
They are.
Yeah.
I saw some, especially on the commercial side.
We've always been weary saying, hey, if those products start to come back, that means there's a time period, an expiration date before foreclosures will start again.
That's true.
So
That's true.
we have to be mindful of that. It's in the early stages. So as we go through 2022, we know it's rumbling that way, but it's not here yet.
Right.
So-
And then the other condition was interest-only loans. And there's a 5-1 ARM, 7-1 ARM, and basically you pay only interest for those years.
Only interest. And we know in the early years of a mortgage, you're paying a great percentage of the mortgage just in the interest. So you're really not buying down the principal of
Right.
the note. You're just paying that interest.
Maybe you bought the front door.
Maybe after a year.
Yeah,
Maybe.
you know,
And so you're just chipping away, but you count on the increase in price value of the property to give you your long term, and you're getting cash flow. You're getting greater cash flow with interest only loans because you're paying less money each month.
That's right.
So now that's the time to get your cash flow at the expense of buying down the principal.
That's right.
So it's everything's a give and take, and you have to be mindful of that.
Yeah.
But those types of loans, those alternative loans that aren't 30-year, 15-year, you have to be a little bit savvy, and you have to be leery of just jumping on those because you can get cash flow today, but those things expire.
That's right.
So when we talk about 10-6 loans,
Yeah.
define that 10-6 loan.
So it's a 10-6 ARM, you know, interest-only loan,
rate mortgage ARM.
Yep. And so it's 10 years fixed interest rate.
Same money
Yep.
every month.
And
Okay.
then after that, every 6 months, your rates readjust to whatever percent over LIBOR. So,
That's right.
yeah.
See what the market's looking like.
Yeah.
Check that LIBOR index and say, oh, we need to raise that
Yeah.
couple basis points.
And
or what.
that's going to happen for the next 20 years. So it's really a 30-year loan,
Mm-hmm.
but that thing could balloon so much every 6 months
Yeah.
over the next 20 years.
It could. And so
It's-
when you have those types of products, they're riskier products.
Yes.
You know, anybody
Yes.
invested in stocks knows, hey, there's some riskier stocks
That's right,
than others.
yeah.
And those loans are riskier loans than others.
That's right.
So you still want to be smart.
Because traditionally, you know, I always thought, you know, as a layperson before I got into it,
Mm-hmm.
that, you know, a bank was giving you a loan or a mortgage based off the property.
Mm-hmm.
And really what a bank is doing or a lending institution is giving you a loan based off your income.
Right.
And then the property is to secure
Secure the assets.
Yes.
And so, but
Yes.
if things go south, who are they coming after?
They coming after you.
Coming after you.
But they gonna take that property, you
right.
know, and so that's where the
That's
whole
right.
foreclosure deal goes in. But for many years, like I didn't understand that whole thing. Why do they care so much about my income?
Right.
Because that's the basis of the loan.
Yes.
Not the property. The
That's
property
right.
is just like an added bonus for them. So
Yeah,
you know, it's an interesting way to think about it. you know?
they want somebody's got to be the fall guy.
Yeah.
Is the way it goes. Now, with a lot of when you look at commercial, they know they're going to evaluate that asset heavily because they know they're going to give you less loan to value in it.
Yes.
They might make you pay 20 to 25% versus for residential property, they have you pay from 0 to 5% of the property because they know this asset, we already got a lot of money down. And this is a real asset. It's gonna be here for a while. A house, you can trash that thing.
Yeah.
You can put 30 people in a single bedroom, and then by the time they come around 7 years later, it's just a shell
That's
sitting
true.
there.
That's
So there's
true.
just a lot of variables in that. But again, we're talking about how to win in 2022.
That's right.
And the winners always are on the sideline.
No, the winners are in the game.
In the
or getting prepared to enter the game.
That's right.
Training, developing,
Okay.
getting ready to
Okay, I
go.
hear Steve Austin music in
Hey,
the back.
man,
I hear
that's
that,
right.
that $10 million, the $6 million man.
Hey man, shoot, that's right. What would he cost today though?
Woo,
Lee Majors. That was one of my childhood, and I loved that show,
what
man.
would he be worth today?
Ooh, man, yeah, probably be $6 billion man today.
Yeah, $6 billion man.
$6 billion man.
That's possible.
Yeah, $1 trillion man. Cause that's the cost, man.
Yeah.
And he'd be gangster today. He'd be cold blooded.
This man's got a real flashback going.
I did. I love that dude, man.
Hey, all of this is what's happening.
Music.
No.
Yeah. Oh,
no. You think I just gonna miss it?
Oh,
what's
man.
happening there?
Good,
hey,
man.
those were good times.
That's right.
Hey, but in today's time, winning in 2022, we gotta be smart.
So, what are the current rates? I think I'll tell them.
Okay.
Current rates, 30-year fixed right now, about 4.2%.
4.2%. Great numbers, even if it's a little higher than it was 6 months, a year ago. Those are great numbers, all-time low numbers still.
Yeah, still. And so that was as of February 4th, 2022. So we're still early February. So, everything is kind of still recalibrating, but we're in a very good zone. Now, February right now, or looking back at January, it's about 12% higher, from, purchase price, the median, purchase price of a home right now than it was a year ago. So,
so when we talk about when we talk about interest rates going up, so we're evaluating whether it's time to buy or hold your chips or just forget about it. Yeah. Well, we know forget about it is not an option. Yeah. We're investing. We know the value of money sitting under grandma's mattress is worth less today than it was, a year ago, 10 years ago, 20 years ago.
Absolutely.
And rest assured, that money you got sitting in the sock drawer, sitting, in the dirty clothes hamper at the bottom is worth less a year from now, 2 years, 3. At the same time, as the value of the money is going down, the price of the assets are going up.
That's right.
Every asset you name, historically, not this week, next month, but give it a year, give it 2 years, the house is going to cost more.
Yeah.
The cryptocurrency should move north.
Yeah.
We know the stocks are going to move over time.
That's right.
And so that money needs to be in assets.
It needs to be in assets, making it happen.
Yep.
And I can tell you a quick story. My old man was telling me, one of his friends, his grandfather put him into the real estate business, and so he was going to his tenants and picking up money one day before he went to his normal 9-to-5 job.
That's a good activity.
With my dad. Yeah. And he got in there, and he had $8,000 in the car in a bag.
In a bag, okay.
And somebody stole the car.
Stole a car. So they got the $2,000 car and $8,000 worth of money.
He was so sick. He was like,
Yep.
But guess what? He was able to absorb that because he had another $8,000 coming in next month.
Yeah, so he had to take that loss.
Yeah, he took
come back next month.
Now,
next month. If all he had was the cash, then there was no next month. That was the nest egg.
That's the whole point.
That is the point of the
That's
story.
the power
I think I got it. The power of investing. Man, I got it. I figured it. That's what's happening. So many people are just so happy to get the bag. He had a bag of money, and that bag left with the car.
Yeah, and we talking 20, 30 years ago.
So that was a bag, real bag. 8,000. He could buy another 2 cars.
Yeah, man. So, whew.
Yeah. So you want to be in hard assets.
That's
Again,
right.
That's historically what make people wealthy versus, I got some cash, I got some money, or you just all right, you just street rich, you just got a little something.
Yeah.
That can walk away.
No way I would buy a Louis Vuitton bag. And I'm not throwing a shot at the ladies, but I'm just saying I wouldn't spend $2,000 on a Louis Vuitton bag. I'm just saying until I had a property that it can generate me $2,000.
Okay.
And then at some point, $3,000. I could say, okay, I'm gonna pull this and go do that.
Well, I'm gonna cover a couple of things related to that. But first, I gotta make sure all our friends have subscribed. Have you subscribed?
That's right.
And if you did, we know you like to share.
Yeah.
You better share it with a friend. That's because you're getting this info.
That's right.
Man, it's New Year, you're getting all that info. You say, oh man, I'm hip to this crypto stuff. I know this real estate. I'm good with the stocks. And now I'm gonna share it with a friend. So if you've done that, we can probably continue. So as it relates to this investment and what are you gonna do, whether you're gonna get in it or not, So many people have been asking, well, what kind of property should I buy? I'm ready to go. What should I buy? Well, there's a few variables. There's a lot of variables in it, and everyone's situation, case by case basis, is different. But if you never bought your own home and you're about to buy that first property, then the first one should be, as I did, it should be a multifamily property.
So what you mean?
That means a property that's 4 units, 3, 2, or a single family home.
Okay.
First one I bought was a duplex.
Okay.
And the reason it should be your first purchase is because it's harder. You can get FHA financing for one of those residential classes, single family, duplex, triplex, quadruplex. And then after that, you can go into a single family house. Now, if you do it in reverse, get the first property, a single family house, they're very reluctant. Oh, it's very hard. I won't say impossible to go and say, oh, I'm going to move into a triplex, move into a quadruplex. They don't want you to do that because they know you're looking to be an investor. What you going to do with the old house? You know, so if you start with the multifamily and then come down off of that, then you can put, let's say for a scenario, you buy a $400,000 quadruplex and it's your primary residence, you can get away with between 0 and let's say 5%. In this case, we'll say 3%. So 400,000, you're at 12,000 down. Now you spend that same money on the single family, and now it's not going to be probably 400,000. You don't get the advantage of the tenants helping you pay the mortgage or qualify for the property. And so it's hard to go uphill when it's easier to go downhill. So you start with the multi, then you can come down on the single family. A little additional bit of game is, you know, I got a few friends and I'm waiting for Paul Revere to ride in and be my man and take me off into the sunset. So I don't want to get a house. And I'm saying, get your multifamily. You can get FHA financing. Let him get his multifamily. And now you both can still have multifamily, and the next house you buy together as a single family. And now you started with a strong bag.
That is a strong bag.
That's
Cash
right.
flowing.
That's what you have. You
4
got
doors
assets.
getting.
That's right.
Yeah.
That's a play you can do. But if you're saying, well, I'm just gonna wait for him, now you're coming in a weaker state into the relationship.
And you make a great point because rents are increasing every single month now. And right now, the average rent is about $1,800 a month. And that's more than the average mortgage in the U.S., which is about $1,500 a month.
That's right. So here you have the asset. Now when you go buy the next place or move with your boo thing, you can rent this out. You're gonna make your income there. So now you got a small business working for you. While you're getting the benefits of interest, expense deduction. You're getting the benefit of depreciation.
Absolutely.
You're getting the benefit of appreciation on this asset, and it's a more significant asset. You know, if a $100,000 house rises 10%, 10,000 up.
That's right.
If you had $1 million property that went 10% rise, you got a rise in 100,000.
That's right.
So now you have a greater scale working in your benefit. So you want to go for the home run, then you want to go for the cycle, you can hit a triple, a double, a single. See, I went to the Braves. I went to the
the champions, baby.
Come on,
2021 champs.
That's right. Man, we got champs all around this town. That's what we're talking about. So we're trying to have you be a winner also.
Absolutely.
Raise the bag trophy, the asset trophy at the end of the day.
That's right.
That's what we're trying to do.
That's right.
Plan long term by analyzing what's happening short term here.
That's right.
So keep those things in mind as you say, I'm gonna sit on the sideline.
Yeah, man, that's just not a lot of wisdom in that, I can tell you, other than just getting ready. So that's it. That's the only reason.
And you don't want to give them too many keys on the get ready.
No, not yet, man.
But I gotta give you something. I can't hear that.
Wait, man.
You gotta get your credit right.
Okay, we
You gotta get your credit right.
That's that.
You gotta put away that little expendable money, the disposable money. So
but they can't do that if they buying Gucci belts, man.
The Gucci belt, man, you gotta get the Gucci belt, right?
Get the Gucci belt.
No, you don't have to. You don't have to. But you wanna, and we're not saying don't live. You gotta live. But boy, it's so much sweeter to be able to live strong tomorrow than ball today and there's no tomorrow for you.
Yeah, man, the discipline, a little discipline today.
Yep.
You know, so you can
Pays
enjoy
off
it
tomorrow.
Yeah.
And you can have some fun today too.
Yeah.
So Gucci belt.
Hey, I wait.
Okay. Boom says wait on the Gucci
No,
belt.
I'm serious. Look, hey, I had a choice, you know, between getting, you know, a Rolex and a Cartier. And I went with the Cartier.
Okay.
You know,
okay.
and you talking about $3,000 of difference.
I guess
you know?
you're still fashionable either way.
Yeah, so
Yeah. Okay.
still high-end Swiss watch, right?
There you go. Because these assets multiply over time. Let's think about, since he's talking about Cartier, Gucci, and Rolex, let's say $1,000 invested each month for 30 years gets you about how much money at the end of 30 years?
It's a lot of money because you got
over $1 million.
Because you got a 12.
Over $1 million over that time. And here, a lot of us are just throwing away 300, 600, 12, and then saying, well, I don't know how I'm going to get to the retirement finish line. It's because of the choices we're making today.
That's right.
$1,000 turning into $1 million. Where, hey, if we're trying to fly everywhere in the globe during the pandemic, and we got all the Gucci you can have, and all those things, it's at the expense of tomorrow's freedom.
And I'm
security.
we're big on traveling. Like we just saying we're going on at least 2 trips this year, but that's all, everything in its place, everything in its time. You know, like we're not just working to go travel. Like some people, that's all they want to do is travel. But I'm like, what? You live in an apartment, you know, you got, you know, a beater car. Like, come on, let's just get something, get your lifestyle better, because you only going 3, or some of these people go 4 or 5 trips a year. So I mean,
it's fine to go on the trips, but you have to get your house in order.
Yeah, that's
you got to get your house in order.
That's right.
It's been I don't remember the last 30 years I didn't go on a trip and somebody wasn't paying some rent.
That's right. That's real.
Yeah, that mailbox money's still coming.
Yeah.
So I feel pretty good about leaving.
Right. That's right. As you should.
Yes, sir. Yes, sir.
As you should.
That's what we're talking about. We're talking about winning in 2022 through what investing?
Hey, stocks.
Right.
Cryptocurrency.
Right.
Real estate investing.
That's what we're talking about. We're just talking about staying smart, making that bag money, that earned income, go into some of these passive investments and really be assets working for you.
That's right.
So important.
Hey man, look, we done gave him enough on this.
Gave him enough?
We done gave him enough.
Okay,
I know you got all kind of more stuff you could cover.
We can do
But we can do that later, man, because we don't want to bombard them, man. We already gave them enough great information.
Okay, but we want to make sure we get your feedback, get your comments.
That's right.
Please.
That's right. Like, comment below.
Something in there.
Like we got some new hoodies ordered, so as soon as they come in, we're gonna start picking.
Right.
You know, and shooting out. Shout out to Cheryl for commenting, you know, on our newest video from today. So, you know, we might have Cheryl, some coming to you, man.
Okay.
So, yeah.
Good stuff. Hey, we're just talking about winning. That's all we're talking about. Hey, the GOAT, Brady, he didn't win, but then he rode off into the sunset because he rode off a winner.
That's right. He's the GOAT. I don't like him, but he is the GOAT.
Yeah, there you go. I mean, sometimes you just got to give it up for him.
Yeah, Brady's the GOAT. So.
Yeah, you know, all these things. We're talking about
But he's no longer in my division, so sayonara. See ya.
I don't know how much that's helped his division chances.
Hey, man, immensely. That dude is like unbeatable. So.
Yeah, he was that man at the end of the hall you had to go see.
That's right.
Yeah, you're going down that long, dark hall, trying to get to the playoffs, trying to get to the end of the year, and there go that man again.
Oh, man.
There go that man. Yeah. And everybody pulling, Mama! There go that man again. Brady, there go.
Man, I'm telling you.
He took a ride off into the sunset.
Yes.
Oh, that's good stuff.
Enjoy retirement.
Yeah. Hey, stick with winners, man. Stick with winners. And you have to respect the winner.
That's right.
Regardless if they're in your division or not.
That's right.
You have to stick with winners.
That's right.
Hey, and we want you to be winners. We're sticking with you if you ride with us. Pivot Point Investors. How you feeling?
I'm great, man.
Okay, we're going to stick a pin in this one. We're going to come back the next round and give you some more gems. Hey, I'm AC Cash, and this is
JD.
Boom! Trying to keep you being winners. Hey, with stock picks, crypto action, real estate action, divisional winners, college, Georgia winners,
Bulldogs,
Braves winners.
That's right.
Hey, man, we just playing the winning game.
That's right.
What game are you playing?
That's right.
Long term, short term? Leave a comment. Let's cover it. Pivot Point Investors. We're rolling?
Let's go.
We're out of here.